We're trying to wrap our heads around what happens at the end of this year with data that's maddeningly inconclusive. But 2025 is this huge unknown. So how do you even begin to position for something like that when we just don't know what it'll look like?
You know, I think we have to recognize, to your point, that there is a lot of uncertainty. And so we have to make sure we're investing for multiple states of the world. When you think about the upcoming election, depending on the outcome, it could have very different outcomes for tariffs. And then on fiscal policy, we know that the tax cuts are expiring at the end of 2025. So over the course of the year, there have to be, very difficult decisions made about extending those tax cuts or not, continuing with some of the big expenditure packages under Biden or not. And of course, the elections are going to make are going to make those outcomes, very different.
I mean, if you even look at, as I mentioned, the elections we've already had from Mexico to India, both of those saw big moves in the peso and Indian stocks respectively. We have European and now French elections that we have to deal with. It's a market that's been moving dramatically to results that were largely expected, maybe little differences here and there. What's that about? Is it just complacency?
So, I would, at First Eagle, we've been arguing for some time there's been complacency in markets when you look at valuations and equities or credit spreads or even term premium and sovereign bond markets. They're really not pricing these, very large political risk, obviously a lot of geopolitical risks as well. So I think you're seeing these reactions. If the outcomes of the elections aren't going exactly like markets are expecting, we're getting these reactions. And as you mentioned, upcoming elections, UK, France, then the US, plenty of room for volatility.
Well, I've heard the argument, look, obviously when it comes to Trump versus Biden, they are very different people and it is consequential who is elected. But in terms of policy, fiscal policy will continue to be loose. Protectionism is the trade, regardless of who's in the White House. So it doesn't actually make a difference for your portfolio who's elected. What's the argument against that?
I mean, I think it does make very important differences. Protectionism, maybe the degree, how much globalization is advancing or decoupling. That makes big differences for inflation, outcomes, which of course matter to the Federal Reserve and other major central banks. And on fiscal policy, we are going to have to make some very difficult decisions this coming year. And if if either, whoever wins decides not to make those decisions, then perhaps you see more of a reaction in the bond market.
Well, to that point, I mean, we have had this huge supply of duration come to market. Today, we're getting 10-year yields. On Thursday, we're getting 30-year. With that increased supply and a dearth of volatility, we still haven't seen any of these big events. Sure, we get a slight sell-off when the auction doesn't go as good as planned. Is that as bad as it gets?
I mean, I think we can just look back to last year when we saw the more extreme sell-off in rates. Yeah. Then you have the example of sort of the Truss government when there's a real extreme reaction to negative fiscal developments. I don't think we should be complacent. We're still cautious on duration, despite sort of an economic outlook that might call for extending duration, given these very large fiscal risks that are overhanging. And as I said, term premium really not compensating you for lending to the government at longer level at higher.
Well, but I mean, again, this is something, to your point, given the uncertainty of 2025, doesn't feel like it's going away anytime soon. So what does that mean for a bond's place in a portfolio? Because usually this is the staid asset class. It's not going to move that much. It's low volatility, especially if you do any sort of volatility targeting. It's going to get a big weight in your portfolio. So has its place in a portfolio structurally changed?
That is a very good question. So I think it still has a role in the portfolio. We have been keeping duration short, as I think many might be, because the curve is inverted. Gives you a lot more optionality. Perhaps waiting for credit spreads, which have remained very tight. Waiting for credit spreads to widen in order to sort of reorient the portfolio.
Right. By the way, to the point of volatility induced by elections, the France-Germany 10-year spread, as we've been talking, has jumped to the highest since October. So you're really speaking to the right crowd now of the volatility in these bond markets. But it really has been a yo-yo narrative for markets. When we get CPI tomorrow and the Fed decision, is that going to solidify us either way? Or is it going to continue to be a back and forth and a choose your own adventure, interpret the data how you want?
I mean, I think the CPI report tomorrow is critical. If we get a print that's in line with April or slightly worse, as Waller sort of deemed like a C+ report, then I think it likely scuttles a September rate cut. However, if we get something a bit better, then I think it leaves September wide open. So I think we will have, and we'll have 2 more inflation prints before the September meeting. So I think the data will still be influential, but I think these, the data that's coming in will be influential for sort of the course of monetary policy for the rest of this year. But then, as we discussed, into next year, you have these big political events. I
mean, we can't forget the BOJ. It's easy to forget because Wednesday is so big. I know we have to get through that first before we can get to the BOJ. You've started to take down some of your yen hedges. What's your thinking there?
Look, I do think the Bank of Japan is closer. I think that we're starting to see in the data more influence of wage hikes, and that is feeding into service sector inflation. I think this gives the Bank of Japan room, perhaps at this coming meeting, to start to taper its balance sheets. I think we'll get some announcements there. And then probably in the next meeting or 2, maybe another rate hike, which, if you had asked me 6 months, a year ago, I would not have thought they would have been able to move as dramatically. So for us, the decision to remove the yen hedge reflects that we think these interest rate differentials that are very wide between the U.S. and Japan are going to start to narrow from here, slowly, but start to narrow. And the extreme undervaluation of the yen from a fundamentals perspective can then re-exert itself.
Right, and we know that this is a BOJ who pays attention to the yen. I mean, they somewhat have to, given the noise coming from the government. We've had folks come on this program and say, look, it can't be a one and done in terms of a hike. Because if that's what they signal, then weakness reignites itself for the yen. So is this a BOJ that needs to make clear that this is the start of a cycle?
I think the time has come now. I mean, recognizing, all central banks operating under tremendous uncertainty, none more so than the Bank of Japan, but it is time for them to lay out a framework. How are they thinking about exiting from extraordinary monetary accommodation, very large balance sheet, interest rates at still basically 0. So what is their path? What is the strategy? How are they going to evaluate data? They haven't laid out that framework, but I think the time has come. And that uncertainty, as you see, views are all over the place. I think that uncertainty is weighing on the yen.
Right.